Debt can sneak up on anyone. A few high-interest credit cards, a medical bill, a temporary drop in income, or a major life change can turn what felt manageable into something that creates constant stress. When that happens, people often start searching for debt relief or debt consolidation. The problem is that those terms get used interchangeably in ads, even though they describe very different solutions with very different costs and risks. Understanding the difference is the first step toward choosing a strategy that actually helps. Debt consolidation is primarily about reorganizing debt so it is easier to manage, often by lowering interest, simplifying payments, or creating a predictable payoff schedule. It does not usually reduce the amount you owe. You're still paying your debt in full, but hopefully under better terms. Debt relief, on the other hand, is a broader phrase that can include several options, including budgeting support, credit counseling, debt management plans, debt settlement, and in some cases, bankruptcy. Some debt relief approaches aim to reduce the total amount owed, but that can come with credit damage and other consequences. One of the most common forms of consolidation is a debt consolidation loan. This is a new personal loan used to pay off multiple existing debts, usually credit cards. Instead of juggling several minimum payments and due dates, you make one monthly payment to the new lender. If you qualify for a lower interest rate than your cards, you may reduce the total interest you pay and potentially pay off debt faster. The key word is qualify. The best consolidation rates typically go to borrowers with stronger credit and stable income. If your credit is already strained, the loan you're offered may not be meaningfully better than what you have now. Another important factor is term length. A longer loan term can reduce your monthly payment, but it can also increase the total interest you pay over time. Consolidation helps when it improves the math, not just when it makes the payment feel smaller. Balance transfer credit cards are another consolidation tool. They allow you to move high-interest card balances onto a new card with a low promotional rate, sometimes even 0% for a set period. This can be a powerful strategy if you can pay the debt down aggressively during the promotional window. But you have to read the terms closely. Many balance transfers include a transfer fee, and the interest rate after the promotional period can be high. Missing a payment can sometimes trigger a penalty rate. A balance transfer is not a magic wand. It's a structured opportunity to pay down principal faster if you have the discipline and cash flow to do it. Home equity loans and home equity lines of credit are sometimes used for consolidation because they can offer lower interest rates than credit cards. The trade-off is the risk. You're converting unsecured debt into debt secured by your home. If something goes wrong and you can't make payments, you could be putting your home at risk. For some households with stable income, strong equity, and a serious plan to stop using credit cards, this can be an effective tool. For others, it can turn a stressful situation into a dangerous one. Now let's look at debt relief services that focus on structure and support rather than new borrowing. Nonprofit credit counseling agencies often offer budget counseling and may recommend a debt management plan. A debt management plan is not a loan. It's a structured repayment program where you make one payment to the agency, and the agency distributes funds to creditors according to an agreed plan. Creditors may reduce interest rates or waive certain fees, which can make your payments more effective and shorten your payoff timeline. These plans often require that you stop using certain credit accounts while enrolled, which can feel restrictive but can also be exactly what breaks the cycle. The value of a reputable counseling service is that helps you build a realistic budget, set a plan you can follow, and stick to it long enough for it to work. Debt settlement is the most controversial and misunderstood category. Settlement programs aim to reduce the total amount you pay by negotiating with creditors to accept less than the full balance. This usually happens after accounts become delinquent or charged off because creditors are more likely to negotiate when they believe they may not collect otherwise. Many settlement programs involve you stopping payments to creditors and instead saving money in a dedicated account until there is enough to make settlement offers. While this can lead to reduced balances for some people, it carries serious risks. Late fees and interest can accumulate. Your credit score may drop significantly. Collection calls may intensify, and creditors may sue to collect. There is also no guarantee every creditor will agree to settle. Even within a program, outcomes can vary widely depending on your debts, your creditors, and how much you can save each month. Another factor people overlook is timing. Settlement can take time, and during that time, accounts may remain unpaid. That can make it harder to rent an apartment, qualify for new credit, or even pass certain background checks depending on the situation. If someone is considering settlement, it should be a deliberate choice with eyes open, not something rushed into because an ad promised fast results. Settlement is more of a last resort tool for people who truly cannot repay their debts in full, not a shortcut for people who simply want a better deal. Fees are a major area where consumers get burned. Some companies charge high fees, and the way those fees are calculated can make a big difference. It is essential to understand what you will pay, when you will pay it, and what happens if you leave the program early. You should also ask whether fees are based on the amount of debt enrolled or the amount saved, and whether the fee structure incentivizes outcomes that are best for you. Any company that pressures you to sign quickly, avoids providing details in writing, or guarantees specific results is a red flag. Legitimate providers should be willing to explain the process, the risks, and the alternatives clearly. Beyond consolidation and settlement, there are situations where bankruptcy becomes a reasonable option to evaluate. Bankruptcy is often portrayed as a failure, but in reality, it's a legal framework designed to help people reset when debts are overwhelming and repayment is unrealistic. It can stop collections, lawsuits, and wage garnishments in many cases, and it can provide a clearer path forward than years of struggling. Whether it makes sense depends on your income, assets, the type of debt, and your broader financial goals. The most important thing is not to treat bankruptcy as unthinkable if your current path is untenable. For some people, it's the cleanest solution. Choosing between consolidation and debt relief depends on your core problem. If your issue is high interest and too many payments, but you can repay the debt over time, consolidation or a debt management plan may be a better fit. If your issue is that you truly can't repay the debt in full, even with reduced interest, settlement or bankruptcy may be worth exploring. The decision also depends on the type of debt. Credit card debt and personal loans are often candidates for consolidation, management plans, or settlement. Student loans usually follow separate rules and programs. Secured debts like mortgages and auto loans behave differently because collateral is involved. A good service provider will help you evaluate the right tool for the right debt, rather than pushing one solution for everything. No matter which path you consider, the behavioral side is as important as the financial side. Consolidation fails when people use the freed-up credit card space to spend again. Settlement fails when people can't save consistently or underestimate how stressful collections can be. Debt management plans fail when budgets aren't realistic or when emergencies derail the plan. The most successful approach is the one that matches your actual cash flow and your habits. That means building a simple, honest budget, identifying spending leaks, setting a realistic savings buffer for emergencies, and creating guardrails that prevent new debt while you're paying down old debt. When evaluating a company or service, start with basic questions. What exact service are they providing? A loan, counseling, a debt management plan, or settlement negotiation? How do they get paid? What are the total fees? And what results should you realistically expect? Will you be advised to stop paying creditors? And if so, what are the consequences and what is the contingency plan if a creditor escalates? What support will you receive during the program? And how often will you get progress updates? If the answers are vague, rushed, or inconsistent, keep looking. It also helps to think in scenarios. If you take a consolidation loan, what will you do with your credit cards afterward? If you enroll in a debt management plan, can you live without using credit while you rebuild stability? If you choose settlement, Can you tolerate a period of delinquency and possible collection actions while you save? If you are considering bankruptcy, are you willing to get a professional evaluation so you understand the trade-offs instead of relying on fear or rumors? The right choice is the one that reduces stress and leads to a sustainable outcome, not just the one with the flashiest promise. Debt relief and debt consolidation services exist because millions of people need a way out of the debt spiral. The good news is there are multiple paths, and many people do successfully regain control. The best results come from matching the strategy to your situation, understanding the risks up front, and choosing reputable help that focuses on long-term stability rather than quick wins. Whether you consolidate to lower interest, use a structured repayment plan for accountability, negotiate settlements when repayment is impossible, or explore legal options when necessary, the goal is the same: to create a clear plan you can follow until the debt is gone and your finances feel calm again.